So I want you to imagine a single word, just a 5-letter word.
Okay.
And this word is just actively crashing the logistical operations of warehouses across Germany, across Indonesia.
Just one word.
Just one word. It's not a virus, right? It's not some malicious line of code. It's just a 5-letter noun sitting quietly in a drop-down menu.
Which sounds impossible until you actually look at the architecture.
Exactly. Because this is what happens when the legacy accounting term for a financial ledger somehow collides with the manufacturing term for a pallet of raw materials. You end up with this localized, basically a linguistic crisis that costs actual businesses real money.
Real money and massive amounts of time.
Yeah. So welcome to another deep dive. Today, we're taking you along on a deeply technical mission. We are cracking open an incredibly dense internal architectural document.
It is dense.
It really is. It's the Development Charts of Accounts Roadmap for the 2026 update cycle of the osFinancials and TurboCASH software suites. And, while that title might sound like standard corporate documentation, the stakes contained in these pages are just massive.
They absolutely are, because it represents a fundamental rewiring of global enterprise architecture. I mean, we are not looking at a cosmetic interface update here.
Right. It's not just new buttons.
No, not at all. It's not a simple feature patch. This document outlines a comprehensive global overhaul of how businesses will interact with international financial laws.
Yeah.
It dictates how they will localize their reporting and how the underlying database structure will be totally transformed to comply with shifting standards arriving in 2026.
And we are going to explore the hidden mechanics that dictate how global commerce basically speaks to itself.
Yes.
We'll look at the transition from these antiquated hard-coded templates to highly flexible IFRS and GAAP-compliant database systems.
Which is a huge leap.
It's massive. And we'll also dig into the specific and honestly sometimes bizarre regional quirks of global accounting software. Like from the way specific tax laws in Italy force developers to invent invisible ledgers.
Oh, that Italian split payment rule is wild.
So wild. Or, the reason why a developer building a Greek translation file has to actively fight the root text encoding of a Windows operating system just to make the word for invoice appear on a screen.
Right, because the overarching theme of this 2026 roadmap is really a shift from isolation to interoperability.
I like that phrasing.
Yeah, well, the legacy systems, they were built as localized software islands, basically.
Right.
They solved immediate regional problems, but they completely lacked a unified framework. So the updates planned for 2026 force these isolated systems into a fluid, internationally standardized ecosystem.
Preparing the software for an era where cross-border compliance is not just expected, but it's legally mandated. So I want to start by looking at what they are actively tearing down.
Yeah.
Because the roadmap spends a significant amount of time discussing the deprecation of what it calls flat legacy industry templates.
Right, the flat files.
Yeah. And the documentation specifically points to older Africans files. There are templates labeled bordery, which translates to farming.
Right.
There's Kirk, which is church. Medes for medical.
Yeah.
And these were hard-coded, industry-specific files that have survived for years, just, sitting there in the software. But the roadmap mandates their removal because they completely lack modern compliance for things like VAT or the South African Revenue Service.
Well, and the failure of those legacy templates wasn't just a matter of outdated tax percentages,
What do you mean?
The failure was structural. They were built on a flat file architecture. And to understand why the 2026 overhaul is so critical, you really have to understand the limitations of a flat file.
Okay, so break that down for us.
In database terms, a flat file is essentially a two-dimensional sequential list. It is a single table of data where every record is a line and is completely independent of the others.
So if I'm visualizing this, it's like a flat file is basically a massive pile of receipts sitting in a shoebox.
Yes, exactly.
You have all the data,
Yeah.
but none of it is inherently connected or categorized in a way that implies a broader relationship.
That is an excellent way to conceptualize it. I mean, if an auditor needed to pull a comprehensive report on, say, specific operational liabilities over a 3-year period, the flat file system just struggles immensely.
Because it doesn't know how things relate.
Right. The software essentially has to scan that shoebox line by line, hoping the historical data entry was perfectly consistent.
Which, human error being what it is never is.
Never. So the audit trail becomes completely opaque because the data lacks logical grouping. The 2026 roadmap replaces this entirely with a modern 5x3 structure sub-account template.
Okay, let's break down the mechanics of that 5x3 structure, because the documentation really relies heavily on it.
Yeah, it's the core of the new system.
It describes using a 5-digit root for consistency, combined with a 3-digit suffix for deep sub-account analysis. So, for example, an account might be coded as G110000001.
Right.
How does moving to this specific relational numbering system actually solve the shoebox problem?
Because it introduces a relational foreign key framework natively into the accounting logic. So that 5-digit root, the G11000,
Yeah.
that acts as the unchangeable parent category recognized by international reporting standards. That root tells the software, hey, this is fundamentally a cash asset.
Oh, I see.
And then the 3-digit suffix, the 001, is the highly localized business-specific child account.
Okay, so give me an example of what that child account would be.
It might represent a specific petty cash drawer in a specific regional office.
Oh, that makes perfect sense from a query perspective.
Right.
So when the software needs to generate a balance sheet for an external auditor, it doesn't have to scan every individual transaction in those little suffix accounts. It just queries the 5-digit roots, aggregates the data instantly, and provides a perfectly clean, universally recognized report.
Yes. The local user gets their granular detail, and the international auditor gets their standardized summary.
And that dual capability is really the cornerstone of modern compliance, isn't it?
It absolutely is. It bakes IFRS, International Financial Reporting Standards, and local GAAP directly into the database architecture.
Yeah.
And the roadmap actually grades the severity of this transition. It notes that under the old flat templates, maintaining consistency was rated as hard to maintain.
Which is putting it mildly, probably.
Oh, for sure. And comparability between different business units yielded what they call limited detail. But by forcing the migration to the 5x3 relational books, consistency becomes automated.
Right.
And comparability achieves a high detail rating.
But, the structural shift that genuinely caught my attention isn't just about how the accounts are numbered. It's actually about the physical memory allocation within the database itself.
Oh, the character limits.
Yes. They are calling it the 128-character revolution.
Yeah.
Because the legacy architecture imposed a highly restrictive 35-character limit on account and group descriptions.
Which, to a modern developer, a 35-character limitation for a data field seems completely archaic.
Yeah, it sounds crazy now.
But we have to remember the era in which those legacy systems were designed. In the days of early desktop computing, memory was an incredibly scarce resource.
Right. Measured in kilobytes, not gigabytes.
Exactly. So a 35-character string allocated just enough bytes to describe a basic function without bloating the database size or slowing down the processor.
But applying a 35-character limit to modern global finance is like trying to summarize a complex, multi-jurisdictional legal contract in a single text message.
It's impossible.
You're forced to remove vowels, you got to mash abbreviations together, and you just drop crucial context.
Yeah.
And if a user happened to paste a longer description into that field, the documentation mentions they would hit the dreaded SQL error, NATS 303.
Yeah, the SQL error -303. That is a string truncation error, and it is catastrophic for data integrity.
Why is it so bad? Like, what actually happens?
Well, when a database table is strictly defined to hold 35 characters and an application tries to insert a string of 40 characters, the database doesn't simply cut off the last 5 letters and move on.
Oh, it doesn't.
No, not in many rigorous database environments. It completely rejects the entire transaction. The row just fails to write.
Wow.
So if that transaction was part of a batch posting, a single truncated string could crash the entire ledger update.
Leaving the financial records in an incomplete, completely corrupted state.
Exactly.
I was looking at how this impacts statutory reporting, too, because expanding the field from 35 characters to exactly 128 characters, along with extending the bat type field from 16 to 148 characters, it isn't just a quality of life improvement for a bookkeeper who wants to write longer notes. In strict jurisdictions, an abbreviated account name is legally non-compliant.
Oh, 100%.
So if a local tax authority in, say, Germany or Brazil mandates that a specific liability account must be reported using a highly specific 80-character legal phrase,
Right.
and your software truncates it at 35 characters.
Your software is generating fraudulent reports, period.
That's terrifying for a business.
It is, because statutory compliance frequently requires exact legal terminology. If the printed ledger does not match the mandated terminology character for character, the business can face severe audit penalties.
Yeah.
So the expansion to 128 characters is basically the invisible bedrock that allows full, unedited statutory account titles to exist safely within the system.
But expanding those database columns across millions of rows of global data, I mean, that fundamentally alters the server load requirements.
It does, yeah.
But it's a necessary structural foundation.
Right.
Because if the database architecture works flawlessly, but the interface that the human being actually interacts with is broken, the entire system still fails.
Right. The UI matters just as much.
So we've rebuilt the database to handle these massive 128-character legal phrases. But what happens when that massive string of text hits a standard computer monitor?
You run out of horizontal pixels.
Exactly.
Yeah.
And that introduces a completely different nightmare that the developers are trying to solve in 2026.
Yeah, this is where database architecture basically collides with the physical limitations of user interface design.
Yeah.
The 2026 roadmap introduces a strict global noun-only strategy across all 105 localized language files.
A noun-only strategy. The documentation points out that a button or a menu bar on a standard display has a finite amount of horizontal space.
Right.
In English, a command string might be relatively short, like use this document or edit the badge. But the developers are systematically going through the software and removing redundant verbs.
Which is super interesting.
It is. Instead of a button saying edit document, the mandate is to simply use the noun, editor.
The global constraint forcing this UI philosophy becomes very clear when you look at languages with expansive character counts.
Like which ones?
German, Xhosa, and French. They frequently utilize compound words or much longer structural grammar.
Right.
So a German compound word for a specific processing function can easily stretch entirely across a legacy menu bar. And when that happens, the layout engine of the software pushes other vital navigation buttons completely off the edge of the visible screen.
So the buttons are literally pushed out of existence for the user.
Basically, yeah.
By shifting to a noun-only approach, the software aggressively reclaims those horizontal pixels. It prevents text from wrapping awkwardly or truncating on smaller displays.
Which is especially critical as enterprise software moves from large desktop monitors to tablets and mobile interfaces.
Oh, totally. But as I was reading through the linguistic standardization efforts, I kept coming back to the situation with the word batch.
Ah, yes. The Great Batch Crisis.
The developers literally had to create a dedicated file, the English-journal.dfm file, just to eradicate the word batch from the financial processing side of the software.
The issue with the word batch perfectly illustrates the danger of ambiguous terminology in an integrated software ecosystem.
Oh, so?
Well, in legacy accounting, a bookkeeper would gather a stack of physical invoices, enter them into the software all at once, and process them. They called this batch processing.
Right.
And it was an accurate description of the workflow.
But modern ERP systems don't just handle accounting anymore. They handle the physical logistics of the business as well.
Precisely the friction point. Because if the software is managing a manufacturing plant, a batch refers to a physical run of production.
Right, a batch of raw steel or a batch of pharmaceuticals.
Exactly. It represents physical inventory moving through a warehouse.
Yeah.
So if the user interface uses the word batch to mean both a financial entry in the general ledger and a pallet of goods on the loading dock, you introduce severe cognitive dissonance for the user.
And the roadmap details how this ambiguity was causing real-world data entry errors. Like, the German localization team had to completely rework their language files because of this.
Yeah, they had a major issue with it.
They had a legacy term, Staplerfassung. And the root of that word, staple, implies a physical stack or a pile.
Right.
So they mandated a transition to the term Journalfassung, anchoring the UI firmly to the concept of a financial journal.
And the Indonesian localization team faced an identical crisis.
Oh, really?
Yeah, their warehouse operators and financial controllers were literally colliding within the software because the localized terms for processing were just too similar.
Wow.
Standardizing on the word journal globally removes the physical implication of the action. It's really a defensive design choice. The vocabulary of the interface is actively protecting the user from making a logistical mistake in a financial module.
That's fascinating. So we see that massive effort to standardize a single concept universally. But the roadmap also dictates areas where the software must hyper-localize to an almost obsessive degree. And it's not just translating between different languages, it's separating dialects within the same language based entirely on geographical borders. The North American rollout strategy for 2026 is a fascinating case study in linguistic precision.
It really is. The separation between the United States and Canadian localizations highlights how much professional trust relies on visual familiarity.
What do you mean by visual familiarity?
Well, if a Canadian accountant opens a software suite designed to handle highly sensitive corporate tax data, and they immediately see American spelling conventions, their baseline assumption is that the software is not natively compliant with the Canadian Revenue Agency.
Oh, I see. Because if you get spelling wrong, what else did you get wrong?
Exactly.
And the rules laid out for the developers are uncompromising. For the U.S. files, the system must strictly adhere to the OR and ER rules, words like color and center.
Right.
It also explicitly forbids consonant doubling in specific verbs. So, canceled with one L or
Wow.
traveling with one L. But the moment the software detects a Canadian localization, it must pivot to British English rules. OUR for color, RE for center, and mandatory consonant doubling, resulting in canceled with two Ls.
And beyond the spelling conventions, the fundamental business terminology diverges too. The U.S. templates are programmed to issue an estimate to a vendor.
Okay.
The Canadian templates must issue a quote to a supplier.
Quote and supplier.
Yeah. And these are minor semantic differences to a layperson, but to a certified accountant, utilizing the wrong term in a formal document can render a contract ambiguous or legally questionable.
I found the UX terminology audit section particularly revealing regarding how developers actually influence user behavior. They have initiated a comprehensive phase-out of the legacy preposition PER in favor of the modern standard BY.
Yeah, the shift from PER to BY, that's a reflection of how data analysis has evolved over the years.
How so?
Well, in legacy systems, reporting menus heavily utilize PER, for example, sales per period or revenue per customer.
It sounds highly formal, almost mathematical,
Yeah.
like a scientific citation.
It does. But modern data analysts don't think in terms of mathematical ratios when they pull reports. They think in terms of filtering and grouping.
Right.
The 2026 standard dictates the use of BY to imply the organization of data into specific buckets. Sales by customer suggests a dynamic sorting action. It shifts the tone of the software from a static, formal citation to an interactive conversational query.
That is such a subtle but smart shift.
Yeah.
And accompanying these semantic shifts are incredibly rigid visual rules designed to aid the underlying database architecture.
Oh, the typography rule.
Yes, the parent-child visual typography rule immediately stood out as just a brilliant piece of functional design. The mandate states that parent accounts, the main roll-up summary accounts, must be rendered in entirely uppercase text.
Right, all caps.
Accounts receivable, all caps. But the child accounts, the granular subledgers beneath them, must be rendered in sentence case. Capital T, trade debtors.
And that capitalization rule is not an aesthetic choice, you know. It serves as an instant visual verification system for automated data parsing.
How does that work?
When the SQL database performs an automated hierarchy conversion, like, say, aggregating all the minor transaction data from the child accounts into the parent account for a quarterly balance sheet,
Right.
the visual distinction allows the human operator to instantly verify that the mapping is correct.
Because the software parser reads the uppercase string as a parent node, and the human brain intuitively recognizes the visual hierarchy without needing to check the underlying account numbers.
Exactly. Furthermore, this visual restructuring pairs with deep compliance updates. The Canadian templates are systematically deprecating their flat structures to introduce ASPE-aligned mapping.
Remind us what ASPE is.
ASPE refers to the accounting standards for private enterprises. The localization even drills down into Quebec-centric terminology to handle their unique provincial tax reporting requirements.
Wow.
Concurrently, the U.S. architecture is shifting to natively support LLC and NGO GAAP compliance structures, ensuring the skeletal framework of the software matches the specific legal entity typing of the user.
Changing per to by or adding a U to the word color requires careful coding, but it's fundamentally surface level.
Right.
But what happens when the 2026 roadmap demands that developers completely rewire the core professional vocabulary of an entire industry?
Panic.
Yeah, that triggers a whole different kind of crisis. Which brings us to the UK and South Africa IFRS strategy.
The strategy deployed for the UK and South African markets is just a masterclass in mitigating the psychology of forced software updates.
Yeah, the roadmap introduces the double file language strategy. Essentially, the developers are forced to maintain two parallel, fully translated language universes for the exact same software.
It's incredible.
On one side, you have the standard legacy files, designated as en-uk.dfm and en-south africa.dfm-dfm. These files purposefully retain traditional accounting terminology. They use words like debtors, creditors, and stock.
Because these are terms deeply ingrained in the professional lexicon. I mean, a bookkeeper in London might have used the term debtors every single day for 40 years.
But on the other side, the developers have to build and maintain the new IFRS files, designated en-uk-ifrs.dfm, and these files aggressively modernize the vocabulary to align with FRS 102 and the IFRS for SMEs. Right. In this universe, debtors is replaced by receivables. Creditors becomes payables. Stock is entirely wiped out in favor of inventory.
And the tension here is really between the necessity for global standardization and the reality of user adoption.
But from a purely technical standpoint, maintaining two separate language files for the same region is inefficient.
Oh, absolutely.
It doubles the localization workload. So why not leverage the 2026 overhaul to force the transition? Just rip the Band-Aid off, standardize the global vocabulary onto the IFRS terminology, and deprecate the legacy terms entirely.
Because forcing that transition abruptly creates a devastating operational bottleneck at the customer support level.
Well, I can imagine.
Yeah, the documentation outlines this technical rationale very clearly. If a veteran accountant logs into the system on a Monday morning and the ledger for debtors has vanished from their dashboard, replaced by a module labeled receivables,
Yeah.
their immediate reaction is not to assume a standardized linguistic update has occurred.
Right. They aren't reading patch notes.
Exactly. Their immediate reaction is that the software has critically failed and deleted their customer balance data.
They flood the support desks with panic tickets.
Exactly. The double file system acts as a psychological buffer. It respects the established habits of existing users by allowing them to default to their legacy terminology so they can operate their business without interruption.
Yeah.
However, the software must also cater to the incoming workforce. Recent university graduates are trained exclusively on international standards.
Right.
So if a newly hired controller boots up the software and sees stock instead of inventory, they view the software as archaic and potentially non-compliant.
That makes a lot of sense.
By offering the specialized IFRS language file, the architecture bridges the generational divide without triggering a mass panic among legacy users.
That concept of bridging historical data with modern architecture is also visible in a highly technical failsafe built into the chart of accounts structure.
Oh, the no man's land.
Yes. The roadmap explicitly outlines a directive to reserve the G7000 class block of accounts, and they literally refer to it as a no man's land.
Reserving account blocks is a vital defensive tactic in database architecture, particularly when you're managing massive structural migrations.
I was looking at the old flat Africans structures we discussed earlier, and in those legacy files, the G7000 block was universally utilized for recording expenses.
Right.
But under the new 2026 standardized model, expense reporting is being relocated to a completely different numerical range. Yet the developers are strictly forbidden from reassigning the G7000 block to a new category. Why leave that prime database real estate completely empty?
Because of how relational databases handle data merges. Eventually, a company using the legacy software is going to execute an upgrade, right?
Yeah.
They'll be merging their 10-year-old historical database into the new 2026 IFRS structure. If the developers had optimized the system by reassigning the G7000 block to represent, for example, fixed assets in the new version,
Oh, no.
yeah, the merge would cause a catastrophic data overlap. The system's foreign key framework would read the historical expense data coming in from the old file, see that G7000 tag, and forcefully map a decade's worth of operational expenses into the new fixed assets ledger.
It would completely destroy the integrity of the company's historical financial reporting. The balance sheet would be hopelessly corrupted.
Totally corrupted. So by declaring G7000 a no man's land, the architecture guarantees that when a legacy merge occurs, the old data lands safely in an isolated, inactive account block where it can be properly mapped and archived without overwriting active ledgers.
That is so smart. But the documentation also suggests a secondary, future-focused reason for holding these blocks in reserve. It mentions function of expense reporting.
Yes. Advanced IFRS reporting often requires businesses to classify expenses not just by their nature, like rent or payroll, but by their function within the company,
What's an example of that?
like separating administrative expenses from research and development.
Okay, I see.
By leaving strategic numerical gaps in the foundation now, the developers can roll out function of expense categorization in a future update without having to tear up the relational architecture all over again.
This idea of preserving historical integrity and strictly defining how data can be categorized naturally brings us to environments where that integrity is legally monitored on an incredibly granular level.
Yeah, Europe.
The roadmap's pivot to continental Europe reveals a landscape where language rules, cultural norms, and relentless tax compliance are completely intertwined.
The Francophone localization strategy is perhaps the most sprawling example of this complexity. The French localization files are not merely designed for users operating in France.
Right. The roadmap details the support for the OHADIA system. That is the Organization for the Harmonization of Business Law in Africa. It is an extensive legal framework adopted by 17 African member states, nations like Benin, Senegal, and Mali.
Mm-hmm.
Additionally, the software has to support Caribbean variants like the PCN standards used in Haiti. These regions are unified by the French language, but they are legally bound by highly specific regional charts of accounts.
And the technical backbone required to support this is the French PCG, the Plan Comptable General.
Okay.
It operates on a legally mandated 10-class decimal system.
Wow.
Yeah. The database must be structured to accommodate this exact decimal hierarchy, or the software is instantly non-compliant across dozens of international borders.
To achieve this, the development team had to manually translate and verify 4,071 individual labels.
Yeah, over 4,000.
But reading the roadmap, it's clear the translation itself was only half the battle. The real struggle was fighting the database engine's character encoding. They spent massive development resources fixing display issues deep within the Firebird databases just to properly render special characters like the CCDA and the E-acute.
Well, because character encoding is the foundational layer that translates binary data into readable text.
Right.
If the underlying database is programmed to store data using an older encoding standard like Latin 1, but the localized user interface expects a modern UTF-8 format.
What happens?
The moment the software encounters an E-acute, it panics. It doesn't know how to map the bytes. So it renders a black diamond with a question mark or just a string of random symbols.
We've all seen that on a broken website.
Right. But in a legally binding financial document, unreadable characters in an account title can render an invoice invalid.
It reinforces the reality that a perfect translation is useless if the database engine destroys the text before it reaches the monitor. And while the French localization focuses heavily on this multinational legal framework, the German localization strategy zeroes in on something entirely different: cultural tone.
Yes, the tone shift.
The German roadmap covers what they call the Big Four: Germany, Austria, Belgium, and Switzerland. And it mandates a fundamental shift in how the software speaks to the user.
It's the integration of cultural politeness into the user interface.
In older, legacy versions of the software, the interface relied on blunt, command line style alerts. The system would just bark a single word or harsh phrase at you.
Save document. Error.
Yeah. The 2026 roadmap dictates a sweeping transition to polite, fully formed sentences. Instead of a hard-coded button that just says Save Document, the German UI is programmed to ask, Möchten Sie diesen Beleg speichern?
Which means, would you like to save this document?
Yeah.
It is a deliberate psychological design choice. Moving away from an abrasive, machine-like interaction fosters a more cooperative and professional environment. It builds trust. However, beneath this highly polite conversational user interface is an incredibly rigid, unforgiving, automated tax engine.
Yeah, the automatic tax triggers in the German localization represent the absolute pinnacle of accounting automation.
They really do.
In the German software environment, particularly when interfacing with standards like Date AT, the manual calculation of taxes is almost entirely removed from the user's hands. When a bookkeeper posts a transaction to a specific revenue account, the account number itself dictates the tax behavior. The user doesn't have to manually select a tax key from a drop-down menu or manually calculate the 19% standard VAT rate.
Right.
The software reads the account number, automatically splits the VAT out of the gross amount, and routes the tax liability to the correct clearing account in milliseconds.
And the precision required at the database level to support that automation is just staggering.
Because if it's wrong,
Oh, if it's wrong, it's a disaster. The relational mapping between the general ledger and the tax tables must be flawless. If a developer maps a revenue account to the wrong internal tax trigger, the software will silently and automatically calculate the company's tax liability incorrectly across thousands of transactions.
Completely bypassing human oversight.
Exactly, which explains a very specific technical mandate hidden in the translation guidelines.
Oh, the XML tags?
Yes. While the localization team is busy translating 885 individual labels in the German files and making the sentences culturally polite, they are under strict orders to preserve all technical XML debugging tags embedded in the text.
This is a critical point of failure in software localization, isn't it? Translators who lack programming context often see strings of code wrapped in brackets, like intern Untermensch, which translates to internal subset, and assume it is leftover text that should be deleted or translated into conversational German.
But if they delete those XML tags, the electronic tax reporting pipeline collapses. When the software generates the required XML files for automated submission to the German tax authorities, those tags form the structural skeleton of the digital document.
Yeah.
Furthermore, if a tax authority rejects an automated filing, the developer relies on those exact debugging tags to trace where the data mapping failed.
So it requires a delicate surgical approach. You have to completely overhaul the human-facing language while fiercely protecting the machine-facing code.
Exactly. And while German precision relies on these internal automated database triggers, other regions require the software to step outside the standard buyer-seller relationship entirely.
Yeah.
The tax mechanisms built directly into the localized software for Southern Europe and Asia introduce legal complexities that challenge the fundamental logic of double-entry bookkeeping.
The Italian roadmap introduces a localization requirement that seems structurally backward from a database perspective. It revolves around the Italian split payment rule, or the cessione dei pagamenti.
The split payment mechanism is a highly effective tool deployed by the Italian government to combat VAT evasion, but it forces developers to build invisible ledgers to reconcile the math.
Okay, let's trace the standard logic first. In a normal transaction, a business sends an invoice to a client for goods.
Right.
The client pays the total amount, the cost of the goods, plus the value-added tax directly to the business. The business holds that VAT in their bank account, and at the end of the quarter, remits it to the government.
That is the standard flow of capital.
Yeah.
And it is how accounting software natively expects money to move.
But under the cessione dei pagamenti, if a business is invoicing a public administration, like a state-run hospital or a government ministry, the rules change entirely.
Complete.
The state pays the net amount of the invoice directly to the vendor, but it bypasses the vendor completely regarding the tax, paying the VAT directly to the national treasury.
Right.
The vendor never touches the tax money.
Now, consider the logical conflict this creates within the software's ledger. The system generates an invoice for 1,000 euros in services, plus 220 euros in standard IVA, the Italian VAT.
Okay.
The accounts receivable module registers that the client owes the business 12,220 euros.
But the bank feed only registers a deposit of 1,000 euros from the government.
Exactly. The foundational logic of the software registers a short pay. It assumes the client is delinquent on the remaining 220 euros.
Oh, wow.
And furthermore, because the invoice included 220 euros in IVA, the software's internal tax engine automatically records that the business currently owes the government 220 euros at the end of the quarter.
So the software thinks the client hasn't paid and simultaneously inflates the business's tax liability, telling them to pay the government money that the government has already collected from itself.
Yes.
It's a localized logic bomb.
It is. To resolve this, the 2026 roadmap mandates the creation of dedicated IVA split payment clearing accounts built deeply into the foundational Italian database template. The software must be programmed to recognize the specific class of the client, intercept the automated tax trigger, and route the 220 euros into a clearing account that automatically nullifies the tax liability and balances the receivable ledger.
All without manual intervention from the user.
Exactly.
The software architecture basically has to perfectly mirror the exceptions in local tax law, and the fragmentation gets even more intense as we look at the Spanish and Portuguese spheres.
Oh, yeah.
The mandate here isn't just about managing varying tax rates. It's about fundamentally recognizing that a single language file cannot serve a massive linguistic diaspora.
Right. The roadmap enforces a strict separation between the software deployed in Spain and the software deployed across Latin America.
The friction for a developer trying to build a unified Spanish module is immense.
Oh, it's impossible.
In Spain, The legal term for a delivery note is an alburon. But if you deploy that term in Latin America, it causes widespread confusion.
Because they don't use that word.
Right, depending on the country. The legally recognized term is a remito or a guía de despacho, and the taxation variables are incredibly volatile. Spain operates on a relatively stable standard IVA of 21%,
Yeah.
but cross the Atlantic, and the software has to dynamically handle Panama's 7% ITBMS or adapt to Argentina's 30% BI's tax, which applies specifically to foreign currency transactions.
So a developer cannot hard-code a standard VAT rate into a Spanish language pack because doing so immediately breaks the software's compliance in over a dozen other nations.
Right.
We see a similar linguistic division in the Portuguese localization. The software must distinguish between Portugal, where an invoice is a fatura, and Brazil, where it is a nota fiscal. But the Portuguese roadmap also introduces a fascinating UI directive termed syllable economy.
I found the mechanics of syllable economy brilliant. The developers recognize that direct translations into Portuguese often result in significantly longer word counts.
Yes.
And given the horizontal pixel constraints we discussed earlier, the roadmap explicitly mandates the use of shortened, specific terminology to save screen space.
Right, the pixel crunch.
Instead of using a literal multi-word translation for balance sheet, the guidelines mandate the use of the single word balanço. It's the noun-only strategy hyper-applied to Portuguese syntax to ensure the UI remains clean and functional.
And moving further east, the roadmap outlines significant legislative and technical hurdles in the Asian and Eastern European localizations.
The updates required for the Indonesian market highlight how dynamic tax environments force constant architectural updates. The documentation notes that developers must prepare the system for a mandated statutory VAT increase from 11% to 12%.
Right.
But they also have to code and support for the DPP Nilai Lane mechanism.
DPP Nilai Lane translates to other tax base values. It is a complex mechanism utilized in Indonesia where the effective tax rate is applied to a specific percentage of the total transaction value rather than the gross amount.
Oh, that sounds complicated for the math engine.
Very. The software's mathematical engine must be flexible enough to automatically apply these varying base values depending on the specific class of goods being sold.
And while managing that complex math, the localization teams must also manage brand integrity. The roadmap details the reintroduction of dynamic placeholders across all language files, specifically highlighting the APPNME placeholder tag.
Which is a vital protocol for protecting the software's core identity during mass translation.
Because without this placeholder, a translator working on a distant, localized file would have to manually type osFinancials or TurboCASH into the text string.
Every single time.
Every single manual entry introduces the risk of a typo or forces the brand name to be hard-coded into a specific language structure. By embedding the APPNAME tag, the software dynamically queries the core configuration file and populates the correct, perfectly capitalized brand name at runtime.
It protects the branding across all 105 languages effortlessly.
It ensures that regardless of how deeply localized the software becomes, the core identity of the product remains intact and technically flawless.
But the absolute peak of the technical hurdles in this roadmap has to be the troubleshooting story detailed in the Greek localization section.
Oh my goodness, yes.
It perfectly encapsulates everything we've talked about regarding how language, law, and database architecture relentlessly collide.
The incident with the corrupted Greek headers.
Yes. The Greek localization team had successfully completed their mandate. They meticulously translated all 4,072 labels into Greek. From a linguistic standpoint, the file was perfect. But when the QA team booted up the software to test the new language pack, the user interface completely shattered.
Just broke.
The navigation headers were corrupted. The drop-down menus displayed random, unreadable symbols. The software appeared to be fundamentally broken at the code level.
In a scenario like that, the immediate assumption by the development team is usually that the translation file itself contains a syntax error, right? Perhaps a missed bracket or an unclosed string that broke the parser.
Exactly. They assume human error. But this wasn't a language error at all. It was a deep architectural encoding conflict. The legacy display controls within the software's framework were programmed to read text using an older encoding standard known as Windows 1253. Which was historically used for Greek characters in legacy Windows environments.
Okay.
However, the new 2026 translation files were authored and saved using the modern universal UTF-8 encoding standard.
So they were literally speaking two different digital languages at the byte level.
Yes.
When the Windows 1253 legacy control tried to interpret the UTF-8 data stream, it misread the byte markers entirely, translating perfectly valid Greek text into chaotic gibberish on the screen.
And the resolution required hardcore technical troubleshooting. The developers couldn't just fix the text, they had to force the software's architecture to adapt.
How did they do that?
They had to manually intervene in the configuration files, adding a specific command, ALTFONT equals true, to aggressively force the legacy controls to bypass their default behavior and utilize a Unicode-compatible font.
Wow.
Furthermore, they had to run the translation files through a converter to strip out hidden byte order marks that were confusing the parser.
So all of that incredibly dense, complex computer science had to happen, simply so the word for invoice, tymologio, could appear correctly on a monitor in Athens.
And that Greek troubleshooting incident proves the core theme running throughout this entire 2026 roadmap. Localization is never simply translation.
No, it's not.
You cannot just hand a spreadsheet of English terms to a linguist and expect compliant, functional software to emerge on the other side. Localization is the brutal, exacting intersection of localized tax law, regional linguistics, and deep, unyielding database architecture.
That brings us to the conclusion of the roadmap. We have covered an immense amount of technical ground today. We've explored the mission to deprecate the rigid, shoebox-style flat files and replace them with a highly flexible 5x3 relational ecosystem.
Yeah.
We dug into the mechanics of the 128-character database expansion, examining how SQL string truncation forces developers to rebuild the underlying memory allocation just to support legally mandated account titles.
We analyzed the interface constraints, examining how the noun-only strategy reclaims horizontal pixels from expansive languages, and how eliminating ambiguous terms like batch prevents logistical collisions in the warehouse.
We tracked the hyper-specific regional divides from the UX data bucketing logic of changing PER to BY in North America to the psychological buffer of the double-file IFRS strategy in the UK and South Africa, ensuring legacy users aren't overwhelmed by modernized terminology.
Right.
And we traveled through continental Europe and beyond, dissecting the French OADS system's encoding demands, the automated tax triggers and XML requirements of Germany.
The complex, invisible ledgers required for the Italian split payment law.
And finally, the deeply structural encoding nightmares of the Greek localization.
It serves as a masterclass in the invisible structural frameworks required to keep the global economy functioning smoothly. But, analyzing this roadmap leaves me with a final provocative thought.
Oh, what's that?
Throughout this entire deep dive, we've examined how human developers, architects, and linguists are painstakingly manually coding regional tax laws, cultural politeness, and linguistic quirks into software databases.
Yeah.
But as global compliance becomes infinitely more complex, as tax rates shift dynamically and digital borders blur, we have to wonder about the future of these systems. Will the accounting standards and localization structures of the next decade continue to be written by local governments and manually coded by humans?
Or will they ultimately be universally generated and standardized by the AI systems designed to manage them?
Exactly. At what point does the complexity of the machine begin to dictate the structure of the financial law, rather than the law dictating the machine?
That is definitely something to think about the next time you hit save on a simple invoice. From the 128-character database columns to the invisible tax clearing ledgers, the clean interface on your screen is hiding an absolute marvel of global engineering. Thank you for joining us on this deep dive. Keep looking closer at the hidden structures around you, and we'll catch you next time.